Have you ever wondered why some people seem to make money while they sleep? Why billionaires obsess over stocks? Why the news constantly talks about the stock market? And why almost every wealthy person on earth owns stocks? Here's something surprising. The stock market isn't just for rich people, it isn't a secret club, and it definitely isn't gambling when you understand how it works. In fact, the stock market is one of the most powerful wealth-building tools ever created. Yet most people never learn what it actually is. So, in the next few minutes, I'm going to explain the stock market in the simplest way possible. No complicated financial jargon, no confusing charts, just a simple explanation that anyone can understand. By the end of this video, you'll know exactly what the stock market is, how it works, why prices move up and down, and why millions of people invest in it every day. So, let's begin. Imagine your friend starts a small business. Maybe it's a coffee shop. At first, your friend owns 100% of the business, but after a while, the business grows. More customers arrive. The coffee shop becomes popular. Now your friend wants to open 10 more locations. The problem? Expansion costs money, a lot of money. Your friend could borrow money from a bank, or your friend could do something different. They could sell small pieces of ownership in the business. This is where the stock market begins. When a company sells ownership to investors, those ownership pieces are called shares, and those shares are what we call stocks. So when someone says they own a stock in a company, they're simply saying they own a small piece of that company. That's it. That's the basic idea. If you own one share of a company, you're a part owner, maybe a tiny owner, but still an owner. Now let's take this idea to a much larger scale. Think about some of the biggest companies in the world. Companies that make phones, software, cars, clothes, food, or online services. Many of these companies have millions or even billions of shares available. Investors buy these shares because they believe the company will become more valuable in the future. And that's where things get interesting. Let's say a company is doing extremely well. Sales are increasing, profits are growing. Customers love its products. As more people want ownership in that company, demand for its shares rises. And when demand rises, prices usually rise too. This means investors who bought shares earlier may see the value of their investment increase. For example, imagine you buy a share for $10. Months later, more investors want that same share. Now it's worth $15. You could sell it and make a profit. That's one of the main ways investors make money in the stock market. But here's an important point. Stock prices don't only go up, they can also go down. Maybe the company makes mistakes, maybe profits fall, maybe customers stop buying its products, or maybe investors simply become worried about the future. When fewer people want to buy the stock, its price may fall. This is why investing always involves risk. No investment is guaranteed, and that's something every investor must understand. Now you might be wondering, where exactly are these stocks bought and sold? The answer is the stock market. Think of the stock market as a giant marketplace. Just like people buy and sell products at a market, investors buy and sell shares of companies. Every day, millions of transactions happen. Buyers and sellers meet through stock exchanges. A stock exchange is simply a place where stocks are traded. Companies list their shares there, and investors can buy or sell them. Today, technology makes this process incredibly easy. You can buy shares with just a few taps on a smartphone, but the basic idea remains exactly the same. People buying, people selling, and prices changing based on supply and demand. Now let's talk about one of the biggest misconceptions about the stock market. Many people believe stock prices move because someone decides what they're worth. That's not how it works. Prices are determined by buyers and sellers. Now imagine there's a rare concert ticket. Thousands of people want it. Only a few tickets are available. What happens? The price goes up. Now imagine nobody wants the ticket. The price falls. Stocks work in a similar way. When many investors want a stock, its price rises. When investors lose interest, the price can fall. At its core, the stock market is simply supply and demand in action. Now here's something that surprises many people. The stock market and the economy are not exactly the same thing. You'll often hear news reporters say things like, "The stock market is up today," or "The stock market is crashing." But the stock market is really a collection of investors making decisions about the future. Sometimes the economy is struggling, yet investors expect better days. Other times the economy seems strong, but investors worry about future problems. This is why stock prices often move based on expectations rather than current conditions. Now, let's discuss another important concept, which is long-term investing. When people first hear about the stock market, they often imagine traders staring at screens all day, buying, selling, watching numbers flash every second. But here's the reality. Many successful investors do the exact opposite. They buy shares of strong companies and hold them for years, sometimes decades. Why? Because businesses tend to grow over time. As businesses grow, their value may increase, and as their value increases, shareholders can benefit. Historically, despite crashes, recessions, and economic uncertainty, the overall stock market has grown significantly over long periods. This doesn't mean growth happens every year. There are ups and downs, good years, bad years, sometimes very bad years. But long-term investors focus on decades, not days, and that's a major difference. They aren't trying to predict what happens tomorrow. They're focused on where businesses might be years from now. Now, let's talk about dividends, because this is another way investors can make money. Some companies share a portion of their profits with shareholders. These payments are called dividends. Imagine owning part of a business that sends you cash simply because you're an owner. That's essentially what a dividend is. Now, not all companies pay dividends, but many do. For some investors, dividends create an additional stream of income alongside any increase in share price. Now let's address the question many beginners ask. Why doesn't everyone invest if it's so profitable? The answer is fear. The stock market can feel intimidating. Prices move every day. News headlines often focus on crashes and uncertainty, and many people worry about losing money. Those fears are understandable, but understanding reduces fear. When people realize that investing often means owning pieces of real businesses, the stock market starts to make much more sense. Instead of seeing random numbers on a screen, they see ownership. Ownership of companies creating products, offering services, and generating profits. That's a completely different perspective. Now let's imagine two people. Person number one spends every dollar they earn. Nothing is invested, nothing grows. Person number two regularly invests part of their income into the stock market. Not huge amounts, just consistently over many years. As time passes, the second person's investments may begin generating returns. Those returns can generate more returns. And over long periods, this process can become incredibly powerful. This is called compound growth, and many people consider it one of the most powerful forces in investing. It's not about getting rich overnight, it's about allowing time to work in your favor. That's a lesson many successful investors understand very well. Now, let's summarize everything we've learned. A stock represents ownership in a company. Investors may make money when stock prices rise. Some investors also receive dividends. Stock prices can go up or down, which means investing involves risk. Many successful investors focus on the long term rather than short-term market movements. And perhaps most importantly, the stock market isn't some mysterious machine controlled by financial experts. At its heart, it's simply people buying ownership in businesses they believe will create value in the future. That's all it is. Simple, yet incredibly powerful. The stock market has helped millions of people participate in the growth of businesses around the world. And while it's not a guaranteed path to wealth, understanding how it works is one of the most valuable financial skills you can learn. Because once you understand the stock market, you stop seeing it as a place where numbers move. You start seeing it as a place where ownership, opportunity, and long-term growth come together. And that simple shift in perspective can change the way you think about money forever. If you found this explanation helpful, make sure to subscribe to Wealth Roots 101 for more simple guides on money, investing, and building wealth.